For the past few years, artificial intelligence has dominated headlines, investment portfolios, and the dreams of Silicon Valley. Trillions of dollars have poured into AI companies. Tech giants have raced to build larger models, bigger data centers, and more powerful chips. The stock market is increasingly driven by the promise that AI will transform every industry. But beneath the excitement, a dangerous question is beginning to emerge. What if the AI boom isn't a revolution, but a bubble? And if it is, what happens when it bursts? The worrying part is that some investors already seem to have an answer, because while the AI bubble may be nearing its limits, another technological hype cycle is already beginning to form in the background: quantum computing. To understand why this matters, we need to look at how modern tech bubbles are created. The age of speculation. Over the last few decades, speculation has increasingly dominated global markets. Investors discovered something powerful. Hype could generate extraordinary returns. Promises about revolutionary technologies could attract enormous capital long before any real profits existed. This pattern has repeated itself again and again. The dot-com bubble of the late 1990s promised to reinvent commerce through the internet. Billions poured into startups that barely had business models. Then came the housing bubble that contributed to the global financial crisis of 2008. In the following decade, cryptocurrencies created another wave of speculative mania. Soon after that came NFTs, digital collectibles that briefly sold for millions before collapsing in value. Today, artificial intelligence has become the newest frontier of speculative investment. Enormous amounts of capital are flowing into AI companies and infrastructure. Data centers are expanding rapidly. Semiconductor demand has exploded. In fact, nearly half of the world's private investment is being funneled into AI, and AI's speculation is the main driving force behind the S&P 500's recent growth. In many ways, AI has become the central narrative driving the current technology market, but there is a growing concern that the excitement may be far ahead of reality. The limits of generative AI. Despite impressive demonstrations, generative AI still faces serious challenges. Training advanced AI models requires massive computational power and extraordinary financial investment. Companies are spending billions of dollars building ever larger models in the hope that additional scale will unlock dramatic improvements. However, many researchers believe the gains from scaling may be slowing. Increasing the size of models requires exponentially more computing resources while delivering only incremental improvements in performance. The recent release of GPT-5 is a perfect example. It had significantly more data, training, and cash invested than its predecessor, yet it is only marginally better. This creates a fundamental economic problem. If the technology cannot improve fast enough to justify the enormous costs, the investment narrative begins to weaken, and profitability remains a major obstacle. Many AI services require huge infrastructure expenses, from specialized chips to massive data centers consuming enormous amounts of electricity. In some cases, the cost of running advanced AI systems can exceed the revenue they generate. OpenAI, which has by far the largest customer base of any generative AI company, is still losing money on every subscription. In fact, analysts estimate they would need to charge more like $2,000 per month just to break even. For businesses hoping to deploy AI tools widely, reliability is another issue. AI models can produce incorrect outputs, hallucinated information, and unpredictable errors. An MIT report found that 95% of AI pilots didn't increase a company's profit or productivity. Research has even found that for 77% of workers, AI has increased their workload rather than reducing it. In other words, the technology still struggles to deliver the productivity revolution that investors expect. When hype meets reality. Financial bubbles often form when investment expectations detach from practical results. During a bubble, investors focus on potential rather than profitability. Capital floods into an emerging sector because everyone fears missing the next technological revolution. But when expectations become too optimistic, Even small disappointments can trigger a shift in sentiment. If growth slows, funding tightens, or new breakthroughs fail to appear, confidence can begin to fade. This is why some analysts believe the AI boom may face a difficult reckoning in the coming years. Even Goldman Sachs, which has poured enormous money into AI, has warned that the AI bubble will likely pop soon. And when it does, it will take the data center bubble down with it, causing immense damage not just to AI companies like OpenAI, Google, and Meta, but also to infrastructure providers like NVIDIA, Amazon, and Oracle. However, the technology industry has an interesting habit. When one narrative begins to weaken, another often emerges. Enter quantum computing. The next major technological narrative gaining attention is quantum computing. Unlike traditional computers that process information using bits, which represent either a 0 or a 1, quantum computers use quantum bits or qubits. Qubits can exist in multiple states simultaneously through a property known as superposition. In theory, this allows quantum computers to explore many possible solutions to a problem at once. If fully realized, this capability could revolutionize fields such as chemistry, materials, science, and cryptography. And for companies struggling with the limitations of current AI models, quantum computing offers a tempting promise. Perhaps dramatically more powerful computing systems could unlock entirely new capabilities for artificial intelligence. Some have even suggested that quantum AI could finally create machines with actual human-level intelligence. Major technology companies are already investing heavily in this possibility. Google, Microsoft, and Amazon are currently developing their own quantum computers. NVIDIA is developing quantum hardware and software platforms. OpenAI recently hired some of the best quantum computing physicists in the world. Even Musk has started to float the idea, and it isn't just the big players. Smaller quantum computing outfits are beginning to see huge amounts of investment. Take Quantinuum, a rather small quantum research startup, which recently raised $600 million, doubling its value to $10 billion. This seems to be the escape pod from the AI bubble to force money and hype into this technology, which promises to solve all the problems the AI world is facing. The reality of quantum technology. However, the practical challenges facing quantum computing are enormous. For one, the hardware is still miles from being fully functional. A true, universally operational quantum computer is still 10 to 20 years away. Qubits are extremely fragile and easily disrupted by environmental noise. Maintaining quantum coherence often requires ultra-cold temperatures near absolute zero, but truth be told, the hardware isn't even the biggest issue, it's the software. In most situations, a quantum computer is actually far slower than a normal supercomputer. It is only in very specific, complex tasks, like calculating factorials, that it can outperform them. However, due to the peculiarities of qubits, these computers can't run standard code. They require specific algorithms designed to exploit quantum behavior, and that's the problem. When you read a qubit, you collapse its superposition, making it just like a regular computer bit, either a 0 or a 1. This renders the entire exponential computing advantage moot. To harness that power, the computer needs to run an algorithm that uses quantum interference to whittle down the qubits before reading. But figuring out these algorithms is incredibly hard, and they only work for very specific kinds of problems. We already have a few algorithms capable of finding factorials or modeling quantum physics, but that's about it. We have yet to find any that work for chemistry simulations or for the neural networks that power AI. Many researchers think there might not even be relevant algorithms for these applications. The kind of data used in AI training is very unstructured, and the actual maths being calculated during training isn't suitable for a quantum computer. So even if big tech can deliver genuinely usable quantum computers, the current science suggests they won't make any difference to AI. Even the notion that our brains are quantum computers, the idea that sparked the whole quantum AI movement, has been pretty much debunked by recent studies. The cycle of tech hype. Throughout modern economic history, technology bubbles often follow a familiar pattern. First, a breakthrough captures public imagination. Second, enormous amounts of capital rush into the sector. Third, expectations grow faster than practical progress. Finally, reality begins to catch up. When profits fail to materialize quickly enough, investment enthusiasm can collapse just as rapidly as it formed. This does not mean the technology itself disappears. The internet survived the dot-com crash and eventually transformed the global economy. But many companies and investors who chased the early hype did not survive. The same dynamic could apply to both artificial intelligence and quantum computing. Technological progress rarely follows the dramatic timelines promised during hype cycles. Artificial intelligence may still transform many industries over the long term. Quantum computing could eventually unlock powerful new capabilities for science and technology. But history suggests that the path from breakthrough to widespread profitability is often far longer and far more complicated than investors hope. The biggest danger is not the technology itself, it's the hype cycles surrounding it. And right now, we may be watching one bubble slowly inflate while another one quietly begins to form. The real question is not whether these technologies will eventually succeed. It's whether the current wave of speculation is sustainable. And when the cycle finally resets, the biggest question will not be which technology wins. It will be who manages to step off the hype train before it stops.